Good morning, and welcome to our first panel here on the impact of COVID-19 on real estate. Your moderator is Tony Lupo. He was given an introduction by our professor earlier. He is a partner at Aaron Fox. He's on our board at the Center for the Business of Fashion. And I personally have appreciated the time I've spent with Tony because he's such a creative problem solver, and we've appreciated that very much on our board. So Tony, you're on.
Thank you. Appreciate it, Beverly. So today, I'm very honored to have three illustrious speakers that have lived through this experience firsthand, and we have it from different perspectives. And so our first speaker is Eva Abrams. She's the general counsel for Kering America. And as you may know, Kering is one of the largest fashion companies in the world. The brands that report to her include Gucci, Saint Laurent, Balenciaga, Bottega, Alexander McQueen, among others. As general counsel, she's responsible for all the legal aspects of the company, from employment to real estate to compliance to privacy and the like. We also have Leslie Horton Campbell, who is with the International Council of Shopping Centers. She's her general counsel as well. The great thing about Leslie is she has experience on both sides of the aisle here. She's going to be able to talk to us about what the retailers have done as well as the landlords. And then finally, rounding us out, we have Richard Johnson. Richard Johnson's with Odyssey Retail Advisors, and he has been advising both landlords as well as retailers in how to navigate this moment in time. Some of his clients include Stella McCartney, Burberry, Goyard, the Wynn Las Vegas, Tishman Speyer, and then Brookfield. So thank you once again for joining us. I think before we get into the topic, we had discussed that I would say something about the current situation and the options that we have available to us, because it's important to understand in many of those instances, we have an existing lease that's binding. And so to get out of that lease, there's only a couple ways to do that. There's one, where you go to litigation, and there are a number of cases going through the courts right now arguing frustration of purpose or force majeure and the like. The second way is bankruptcy, and we've had many clients that have looked at bankruptcy as a means to reorganize. And then the third is going back to the landlord and negotiating, and that's where we're going to spend the majority of our time today. What negotiations have worked? How do we deal with this with different size brands and the like? And so, Eva, I guess I'll start with you, because you have brands that are all different size and price points and the like. And was the strategy you used different for the various brands? Was there one for abatement possibly, and one for deferral, and another for buyout?
Yeah, so I think underscoring this entire crisis from a real estate perspective was that there wasn't necessarily going to be a one-size-fits-all situation and solution for every brand. But at the same time, for groups like ours that were managing real estate portfolios that were rather large and affecting multiple entities and multiple brands, we did have to we had to be creative and try to find a one-size-fits-all solution of sorts for the brands. So I would say it was a mix. Like you mentioned, the first part of the evaluation is examining the contract, examining the lease. And generally, leases are strictly interpreted. So you're kind of bound by the four corners of the lease. And even though many of our retail leases are somewhat similar, there are different nuances. So when, first addressing all of the potential options for rent relief, we took a first look at the leases in general, just to understand if there was some commonality and a common approach that we could apply. And then really it was an exercise of organization and prioritization, where we had a number of brands and retailers in one center. We tried to address them as a bundle and negotiate with the landlord on similar terms. And with that, fortunately, we have the muscle of our group to kind of help us do that. And then for street deals, kind of standalone deals, we really had to kind of do them at a second clip so that we could kind of again organize and prioritize ourselves. But the end result was mixed in terms of what type of deal was struck, whether it was an abatement, whether it was a deferral, a part abatement, part deferral, and in some cases exploring different structures like a percentage rent arrangement in lieu of a fixed rent arrangement, or adjusting a percentage rent arrangement that already existed. So a real mix.
Great. Leslie, what do you think?
So I agree with Eva's assessment in the sense that from some perspective, there isn't sort of a one size fits all, because from looking at it on both sides, there are many factors that potentially can go into what leverage you have in the negotiation. So for example, from the landlord side, if they have, let's say for example, if you're in a mall, there may be anchor tenants, which other smaller tenant leases are hinged or connected to, in the sense that there's this concept of co-tenancy, for example. And so the idea being that many leases, if you are sort of a standard tenant, may require that in order for the landlord to be entitled to their full rent, the landlord must ensure that all of the, usually it's specified, but certain anchor tenants have to remain open and in occupancy at all times. And oftentimes it may be that the mall itself has to maintain a certain threshold. Maybe it's 70%, maybe it's 80% of stores that are open and occupied and open, right? And so to the extent that you have certain players who are asking for rent credits and abatements, it may be the case then that if you're in a certain setting, for example, like I said, as a mall, that whatever that anchor tenant does in terms of retaining their position may be key. Also, if you have financing, that may be another factor, because oftentimes there are lender approvals, et cetera. So it's a very complicated sort of chessboard, if you will, in terms of finding the right pieces so that you maintain your occupancy, you maintain certain anchor tenants that you need. You also make sure that you're not running afoul of any loan covenants that may be in place. And so it can be a tricky dynamic in terms, and also again on the tenant side, if you have a lease that's expiring, you may have greater leverage. So there are so many factors that go into trying to find the right solution for the right tenant. If you are a player from the landlord or development side that has to look at a big picture of all of your tenants together.
Rich?
Yeah, I would say definitely there's no one size fits all that worked for everybody in every location. I think, especially taking the landlord's position, I think they had a lot of triage to do up front. Restaurants, I mean, in New York City, restaurants are still closed for indoor dining. But restaurants tend to not be as well financially backed. So a lot of the landlords, at least in development and mall settings, went to those guys first. They had also had to assess the potentials of bankruptcy and what that meant, and whether some of the brands could survive bankruptcy, and whether there was a willingness to help there or potentially prevent it, as well as smaller mom and pop type stores that certainly don't have balance sheets like big groups or even larger brands in and of themselves. Certainly during those first call it 90 days of this pandemic, the challenging thing was trying to strike the right balance, I believe, the balance of the conversation, whether it's trying to leverage the value or the potential for the litigation that the lease doesn't really call for. There's some, obviously, Anthony and all the lawyers in this panel can tell you there are some at least novel approaches to it that some tenants have taken. I think, especially with my clients and from discussions with many other people, I don't think anyone really felt very confident about those options, at least not enough to gamble, what is and would be millions and millions of dollars in potential obligations that if they went to lawsuits and lost. I definitely found that, so taking the commercial approach to it, the discussion that we would have with the different landlord partners on the tenant side, part of it was also just everyone was feeling the same situation out. I found that tone was very important, and the positioning you took because of that tone, and the actions you took, whether you paid I had clients that paid April's rent, I had other clients that did not. The ones that did, the conversations flowed a lot easier because I think everyone got a bit caught off guard by it, by the entire thing. The whole world to some degree got caught off guard by this. And ones that took a more fervent stance, whether because they had to, because they simply just didn't have the cash to do so, or and went hard against them. They've had I would say the success has been a little bit less, taking the hard approach. A softened approach, I think, has led to more success, and it is definitely a mix of abatements and deferrals. I think the abatements were achieved better with a more friendly and sort of let's get to the end of this tone.
So to the audience, there is a Q&A button down below if you have questions for our panelists as well, and we'll try to address those in turn. My experience has been a little bit different. You know, when I look at a client, the first thing I ask is this a moment where they may have to reorg? And if they do, I would never have that client pay. But it's interesting to hear your perspective on behalf of the landlords that you saw, that the ones that were paying in April and the like actually probably got closer to getting abatement. Different landlords, I had very different experiences with, whether they were going to give an abatement, whether they were going to signal. Some of the largest ones were, I think, afraid to make a move because it was an avalanche for them once they signaled that they were moving and the like. You know, you also bring up, Leslie, the fact that the anchor tenants and the like, and I would imagine if you're an anchor tenant, you would have more leverage to negotiate to some extent than you would if you weren't. But that can also strike against you the other way because, as you said, you know, so many other leases are tied to that. Can you speak on that for a second?
Sure, I think that's right, which is that you're right, it's sort of a balancing act, right? Which is that from one hand, typically anchor tenants generally have, let's say if they were negotiating a new lease, et cetera, generally an anchor tenant will have greater leverage. However, in a time like this where so much is hinged, you have the landlords who obviously want to keep the anchor tenants, but there may be only so much that they can do, right? And especially because I think Richard sort of touched on this as well, which is that anchor tenants tend to be some of the more well-capitalized tenants to start with relative to sort of your mom and pop retailers. And so overall, you find that typically, you know, people are more sympathetic to helping out the small guy who's barely going to make it versus a huge retailer or an anchor tenant who may be a bit strapped, but they may still have you know, somewhat of a more substantial balance sheet than your standard tenant. And so it ends up, I think, in large part to Richard's point, with your relationship with your landlord, right? What's your approach going in? What other deals potentially, what's the rest of your footprint look like? And so oftentimes the solution may end up being something where you're looking at several properties, particularly with your portfolio landlords. And by that, I mean, there are some major, I think Richard himself mentioned that he represents some of the major landlords who own many of the major properties across the country. And so oftentimes, if you are a tenant or landlord, you can sort of negotiate a resolution that addresses several properties at one time rather than doing really sort of a one-off for each location. And that may make more sense for finding a resolution. So it is a balancing act for sure, particularly if you are an anchor tenant.
Eva, how did you guys handle outlets? Was that any different than what you did with regular retail?
No, outlets are the same. I mean, outlets are managed by landlords that are that have full price properties and also outlet properties. So the conversations were the same, and in many cases wrapped up into the conversations for you know, properties and stores and other locations. But just to touch back on the anchor tenant line of questioning, the one thing that we found interesting, that is sort of an interesting development in general, is that many of the anchor tenants being department stores, while, you know, some strong and well capitalized, others we've sort of seen have gotten hit really hard by COVID and have fallen into bankruptcy. So that was an interesting and impactful consequence for us, because we as retailers have our own stores in malls, but we also sell wholesale to these department stores. So when they're struggling, when they become insolvent, it really sort of like a 1-2 punch for our retailers and many others that operate their own stores and also have these wholesale relationships. So, as we saw things unfold, it's sort of that kind of domino effect of COVID, of the store closures that we kind of had to watch out for. So we had a vested interest, obviously, in ensuring that an anchor tenant that's also a wholesale partner survives, because we want them in the malls, and we also want to be able to sell to them.
Right. Good. Rich, I mean, are you worried at all about, we saw some wholesalers go out. Are you worried about landlords going into bankruptcy at all? Because I don't think most people have looked at their lease for that perspective, where, the landlord ends up going into bankruptcy. We could have some real problems as a retailer, especially if you have capital investments in the store and the like.
I mean, I guess it is a realistic scenario. I believe that the most likely challenge, what most likely happen there, though, is that someone else will swoop in to purchase that asset and would want to maintain the tenancy that they have for the cash flow purposes there. I think it's possible, but I think more than likely it just means there'll be more of a fire sale on the valuation of those properties.
Interesting. And then I think you were saying, Leslie, that you were noticing that there was a large difference in geographic scope right now and how some of these malls are performing. Can you speak a little bit about that?
Sure. So I think probably no surprise to many folks if you've had the opportunity to travel to different parts of the country at all. I'm based in New York, but I had a chance to go down south earlier in the summer. And as we all have probably seen or heard on the news, the reactions and the community response to retail, to the pandemic, can vary substantially depending on location. And so, for example, you may find that in a place like in New York, everyone is generally wearing masks. You still have many retail stores that may be boarded up or with reduced hours, and everyone, if you are going to a restaurant, you have to eat outside. Whereas, if just perhaps in Long Island or Westchester, you can eat indoors. And so you find that obviously as a result, the retail follows as a response to what we're seeing in terms of the local laws and regulations of what's permitted. Also in terms of consumer response to that, right? And so in other parts of the country, people are certainly, for example, months ago, I traveled to Jacksonville, Florida on my way down south. And while arriving, my husband, my family, we all had on masks, and we felt odd. I literally felt like we were walking up to rob the hotel because we have sort of matching family masks, and we were the only ones. Everyone else around in the town at the time was sort of walking around. The businesses were open, people were going to the bars, and so it was a whole other world, I should say, in terms of just consumer response, the businesses, obviously what was permitted and allowed relative to where we were coming from in New York. And so all of that to say that, yes, certainly you will see that in certain parts of the country, retail is faring much better right now. Obviously, in certain sectors as well, right? For example, I saw just the other day, there was a line outside of Home Goods, so much so that I had to stop and ask, is there a sale going on? To one of the people sitting, because I thought surely
there's always a sale going on.
Right? I said, surely there must be a reason why there is a line. And obviously it was because they were limiting the number of people inside, but all of that to say that also Home Goods right now are seeing a huge surge, such that even in the midst of a pandemic, you have a store that will have a line down the block. And so absolutely, you're seeing shifts, changes in a whole different world depending on where you are in the country.
Rich?
Yeah. I would add to that. I mean, I think partially it's driven by the government rules, but I would also argue that I think the trauma that the New York metro market sort of went through at the beginning of this really had a large effect on people's bounce back. Much like Leslie, I just recently, about 3 weeks ago, traveled to Colorado, and I was in Cherry Creek Mall there, and it was full, like any mall you'd ever imagine on a good mall on a Tuesday afternoon. And from what I've been told by clients, they're seeing sales that are 30% up year on year from the prior year. The other thing I think we're seeing a lot of is a move to the suburbs and to the resort areas. People that had second homes in the Hamptons have remained out there for seasons, so they've had some of the better sales performances that over the last 6 months than other places. Aspen, the Hamptons, Carmel, those types of places.
So we're starting to get some questions in, and Eva, I'll throw the first one to you. What are your thoughts on companies leveraging current climate with short-term leases? For example, Louis Vuitton has a new short-term location in Soho. Are there any similar plans at your respective companies? So, is this an opportunity if you have cash also to really take advantage of this moment, because leases are clearly well below market?
Yeah, they are and they aren't. I think it's kind of a mix. But absolutely, this is a time where there's obviously been some external disruption. And if the business is nimble and agile, I know a number of panelists have spoken about corporate agility, then they will think about different business models to adopt. Pop-up shops, short-term leases are great ways to sort of hone in on, as Rich mentioned, some of the areas like suburban shopping areas, Greenwich, Hamptons, elsewhere, and pop-up shops in malls that are seeing high activity, that'll allow you kind of to take advantage of the pent-up demand and increased activity in some of the geographical areas without having a long-term investment. I think that's exceptionally important. But of course, those offers have to be on the table. So it's a mix. I think landlords, it's an easy sort of quick cash flow solution for them, but they're also looking for some meaningful engagements and normal term tenancies.
And did you see a difference between high street landlords and institutional landlords in any of these negotiations?
Yes, to some degree, yes. We received very positive dialogue and discussion from high street landlords initially. And probably because they're a little less leveraged and they could be a little bit more creative, and they wanted solutions quickly. So they didn't have 700 properties to manage. So it was a lot easier to get their attention at first. And so we did see a lot of meaningful negotiation and deals being made. Yeah.
So there's another question, and I'm going to address it to you, Leslie. It says, I read that the UK, some of the larger landlords are moving away from traditional leases and looking more on percentage leases. Do you think this is a viable long-term approach?
To move toward percentage rather
For landlords.
For landlords, I
Right.
think it would be tricky from a landlord perspective, because typically the way I should say in certain parts of the world, that's actually pretty standard. So for example, in parts of Asia, in China, Korea, etc., that's already very commonly the case. But those are very, very robust markets. And so in those places, you have, for many brands, their highest sales come from stores out of those markets. And so percentage leases are totally fine because the landlords will make the revenue. So I say that to say that I don't know that would be necessarily to the landlord's advantage in every instance, right? If you are in a market that's doing so-so but isn't really gangbusters, you probably don't want to necessarily resort to that as your first option. So that would be, I think, where you would really depend on just the strength of the market as to whether you can, move toward what you're seeing in places, like I said, like a Japan, Korea, China, where that's already very much the norm. But in other places, it would depend on the location, I would say.
Yeah, I've only seen it in a desperate situation where they're trying to keep the tenant in to make an accommodation.
But
Rich,
I would add one quick thing to that. I think obviously from a retailer perspective, we love that. It's a great certainly. But there are opportunities to kind of have it both ways. I think this whole situation has really underscored the need to hold hands and partner, to get over the hump. I think if we're in this business, we're all inherently optimistic because none of us kind of, cowered once e-commerce boomed, more than a few years ago. So I think we all recognize that this is a temporary event. It may take some time to recover, but one idea is taking the percentage rent structure and applying it temporarily through a, current COVID environment, get you over the hump, 12 to 24 months, and then move back to the original structure. So there are different ways to think about it so that both parties can shoulder some of the risk.
And quite frankly, there are probably many retailers right now who are already triggering their percentage rent because of the co-tenancy failures that are, because to your point, Eva, you mentioned earlier that unfortunately we have seen the demise of certain anchor department stores. And also many retailers, the smaller ones, have not been able to survive because of the decrease in business. And so what I'm sure you probably, for any retailer who's in sort of a center mall setting, I'm sure the first thing they were looking at if they are trying to survive is, okay, wait, have we triggered co-tenancy yet? Because if so, typically the remedy for a co-tenancy failure is that we automatically go to percentage rent. So my guess would be that there are many retailers now who are doing exactly that.
Yeah.
I would add, as far as the landlords and percentage, I think I have seen a number of major New York City landlords who are at least willing to contemplate a more partnership structure that you typically see in the malls. A lower base rent with a percentage upside potential. It was starting before the pandemic that people were having those discussions, and I think this has certainly sped things up, where the landlords realize that it's, to some degree, I mean, not every landlord, but to some degree realize that there's the opportunity to partner with your tenants, and if they're successful, you're successful with them, and also cover your baseline so that you can finance to some degree against future rents.
Speaking of future rents, how has the pandemic affected fair market value? That's the question we have coming in. What markets have been impacted the most?
New York City has been brutalized, obviously. I'm seeing rents trending 30% plus down from pre-COVID.
Even in places like Denver, where you said the malls are still doing well?
I was saying New York. I think there's a built-in discount that everyone's expecting coming out of COVID, because there are just not that many tenants that are active in looking for new locations, because there's so much uncertainty in the world right now. I think 30% is probably your high line, like the most you're going to see, give or take a couple of random locations and the leverage of the brands. But I think everybody's looking at discounts, and I think to the same extent that you and Leslie were just saying, you're going to see a lot of percentage rents starting. It may be 2 years at a percentage rent and then converting to a fixed rent, either at a predetermined fixed rent or a fixed rent based on where the sales were. So a threshold after 2 years, an average of it, and some discount thereon. So you end up at a fixed rent, which allows landlords to finance their buildings.
Leslie, any comment on that?
No, I would agree. I think that certainly, just anecdotally from what I've seen and know from my side of the fence, definitely I would agree. So I think Richard said it perfectly.
And so let's switch gears. I mean, how do you think your portfolio is going to look going forward? Do you imagine, I guess, Eva, we'll start with you as the retailer. Do you imagine that the footprint is going to be the same? Do you think that you guys are going to emphasize e-commerce more? And I would also be interested in what Leslie and Richard think, that, what the new market's going to look like.
Yeah, I mean, I think there are some obvious impacts, right? There's the definite need to invest and use and lean into e-commerce and distribution and different types of distribution models. Pick up in store, curbside retail. We never thought curbside retail would be a thing, but it is, and it can be done in a luxurious way. So there are different ways to think about things. But in terms of long-term impact on the footprint, I think the footprint will be the same. One thing that kind of became clear throughout the crisis with this, bit of pent-up demand and the different, ways that consumers are responding in different geographic areas, there is still a very deep desire on the part of the consumer to have a retail experience and to shop in a store. And I think that's great. In a sense, the pandemic sort of cleared the decks, right? And so I imagine that all of our retail teams are thinking about new and creative activations that will engage the consumer and bring them back to the store, bring them back to the mall. And so I see a lot of concentration on that. But of course, also deep engagement on e-commerce and clienteling as well.
Leslie, Rich, I mean, what do you imagine the footprint for a brand would look like today? If you were, if you had a crystal ball, could redo your portfolio. Are we talking less retail, more, I mean, or let's assume post-vaccine. Let's ask that question.
So one thing I think is that obviously, certainly what Eva said in terms of a push, obviously everyone now is pushing to e-commerce. For those who still are going to make sure to invest in the physical footprint, I do think you have owners, developers who are looking at, and retailers, I'm sure, what is the suburban mix going to look like now, right? Because as we all know, everyone who was previously in the center, well, there will always be a demand there, but certainly the demographic trends or people are sort of decentralizing. And so there will now, retail will follow where the population goes, right? So if you see more people going to the suburban outskirts, now it's sort of, well, how do we reinvigorate some of these areas that previously maybe we started to move away from? I do think you'll start, that would be my crystal ball. So you may start to see some of that. And I think Eva touched on earlier this idea of pop-up shops, which were already actually trending even pre-COVID, right? And that many brands were already looking at how do we test out a market? How do we try and do something different? Because you can do for a smaller space, a short term, you can do something less costly. You can be a bit more creative, something that you haven't tried before to test something out. And so I do think we'll also see more of that, because I think one of the big questions is how much of the changes that we're seeing will be long term, right? So even when you talk about New York, of course, the big question is, will New York, will the other big cities, will it come back in 18 months the way everyone did after 9/11, or will this be a long-term shift of several years that people have gone and may take to come back? I don't know the answer to that, but I do think you'll see more people considering perhaps investing in the suburbs in a way that perhaps we weren't so focused on previously.
Rich?
I would just add that I think to some degree, it's still very brand dependent, right? It depends on the stage in their growth cycle that they're at. If you look at some of the direct-to-consumer brands, they're very, outside of Warby Parker and maybe Bonobos, they're very new to the brick and mortar scenario, so they've already sort of insulated themselves to some degree from the brick and mortar being closed over these past few months. So they, assuming that they're healthy like any other retailer, I can't imagine that they would. It's really about continuing customer acquisition, and the customer acquisition, from what I understand, and I'm far from an online purveyor of goods, but it's becoming more expensive. And as it becomes more expensive, the opportunity to catch people's attention, to get them to actually come in and feel and see and try and understand your story, is important in that space. I think it's important in existing mature retailers as well. And I would say, and Ewa and everyone else in this panel could talk about it from their experience in luxury goods. That's a big part of it. The interaction with your client, the experience, the sort of one-on-one relationship with the sales team, and having that experience is a big part of that. Do I think there's some fallout in the middle? The Gaps and Bananas of the world. J. Crew obviously was just in bankruptcy. Therein lies the challenge, I think. I think both ends of the spectrum. Leslie mentioned home goods before. There's the treasure hunt opportunities in that side that you really have to do physically. You can't do that online. And then I think it comes down to it's overall. It's just about giving your clients a good experience in their brick and mortar store.
So
one
Emma,
other
okay.
I was just going to add one other thing that I don't know if it will become a trend, but I think it could be interesting. We've seen in California that has experienced an initial wave and sort of a second blip in the summer. They when they kind of went to a second closed down situation, they closed indoor malls and they didn't close outdoor malls.
Yeah.
So one thing to kind of maybe keep an eye on is perhaps the proliferation of outdoor malls, even in places outside of California that are not as weather friendly. And we have a couple of examples in the Northeast, and that could be an interesting way to get out milling about. It really has a sort of a main street environment or feel. So especially in a post-COVID world where people are already talking about, well, how long are we going to be wearing our masks once a vaccine is distributed, or how long will a vaccine take? Those properties may become more attractive to developers and retailers to the extent they exist already.
Which is a good dovetail. So for negotiating new leases going forward, what are some of the points that you would be looking for now going forward? I mean, one question, for example, was, would you get a unilateral kickout clause after a period of time? What are the things you're seeing? Which, of course, you would love, but.
Yeah. Do I think we're going to get it? No. Look, this has been a very sort of traumatic event that we're all living through from a personal and business perspective, but at the same time, I don't think that landlords are going to be open to those types of kind of severe remedies. What I think will be a hot button issue is the topic of gross sales, where there is a percentage rent component. We have, obviously all retailers have expanded e-commerce capabilities, launched omni-channel capabilities, which include pickup in store, ship from store, and other store integrations that don't necessarily create a transaction or revenue from that store. So from a retailer perspective, retailers are going to look to exclude those, I wouldn't even say transactions, but those engagements at the store from the definition of gross sales. They don't want to pay percentage rent on them. Obviously, that's revenue generated from another channel, another stream. Landlords, on the other hand, especially now, are much more likely to scrutinize those provisions and seek to kind of cast a wider net and ensure that any type of touch point in their store generates a gross sales implication or a percentage rent implication for them. So I think that's one of the ways that we'll be seeing some shifts.
Leslie?
Certainly, I would agree with that. Also, I think you touched on this, right, which is sort of any sort of termination out. Certainly, there will be attempts also at the force majeure provision and what are your remedies there. As we can expect, whether there will be success in those changes, I don't know, because already typically a landlord's response is, well, you have business interruption insurance that should cover you. And I think, unfortunately, what many retailers found in the course of this pandemic is that oftentimes, typically, business interruption insurance has an exclusion for exactly this type of thing. And so you sort of end up at a standstill, but I don't think that means that people won't certainly try. I think people will begin to try to negotiate those levers of, again, any kick-out rights, anything having to do with co-tenancy and occupancy. I think tenants are going to be also negotiating for where they want to be within the development, because now with the advent of curbside pickup, your location can be very key. If you are trying to provide an opportunity for consumers to come to the store without having to necessarily enter the entire facility, for those which is typically an advantage of being an anchor, right? That you have literally someone can come straight from their car straight into your store, or have curbside pickup right there. So those things, I think, will be the things that tenants now will want to try to negotiate for. So it should be an interesting time for sure over these next 18 months or so.
Yeah, I would add that the challenge that landlords have had about tracking some of this stuff, especially when it comes to seeing people that come in, browse in a store, and then go back to their house and buy online, and has been that there really hasn't been a great way to track that technologically. but it seems to be coming. Like I've heard people at least saying that their technology can do it up to a certain level based on cell phones. So that might be the other half. It's just right now, functionally, it's almost impossible to understand how the landlord could capitalize on a sale that happens in some general way because of the store. I'm not advocating it, by the way. I think that the retailers will continue to fight against it, and they should. Yeah. But it's another story entirely. But I guess as we're having these discussions about where does the percentage rent start and how do you determine those things, there's going to be a trade-off at some point. If somebody's willing to do a pure percentage deal on a very powerful corner or powerful location, the landlord's going to have a little more leverage in the discussion about how do we track the sales outside of just that building.
So sticking with you, Rick, we're getting questions about businesses that do fulfillment as well as retail. So it seems like a lot of malls are starting to try to attract this type of business, especially for the interior. What are you seeing?
I mean, I think we've all heard about the potential of a bunch of the JCPenney's locations being turned into Amazon fulfillment centers. I think that's probably where the question comes from. I haven't seen much honestly on the anchor side of it. What I would say, it is a topic of conversation that goes back as far as small shop tenants. And it becomes a negotiation as to the use clauses in the leases, as to how much can be done in a showrooming capacity or fulfillment center capacity.
But wouldn't you imagine that the leases that you're going to have the landlords actually encouraging this, especially for some spaces that are less important, if they can make it fulfillment centers?
Absolutely.
Yeah.
But I don't believe that most of those the malls that they're considering doing those in are going to be viable retail shopping destinations within the next 5 years. I think the only reason that real estate's available is purely because it's failed as retail, and now the highest and best use is as a fulfillment center or something similar. I think it's a little more, I'm sorry, Anthony, it's a little more interesting when you look at something like Hudson Yards, where they're looking at converting the Neiman Marcus there into office, right? That changes it. I think fulfillment centers, it doesn't drive traffic. It's more it's obviously outgoing trucks and, shipping and things along those lines, other than maybe pickup. But when you look at a very, if it's a good office tenant, I know Facebook was one of the companies that was rumored to be looking at the Neiman Marcus location. The value of having highly paid, technology people entering your building by the thousands compared to a Neiman's, which has a distinct shopper, but it wasn't certainly a huge traffic driver. That could be a more interesting use. And some of the regional mall developers were heading in that direction already by adding Industrious and other co-working centers to some of the challenging department store boxes that they had.
So we have time for one more question, and it's directed to you, Eva. Back to Eva's point about creative activations. Are there any particular sectors of retail or specific companies that have shown more success with adaptations that they've implemented?
So there's an interesting kind of business model that's recently been in the news between Simon Property Group, one of the largest, if not the largest, mall landlords in the U.S., and Authentic Brands Group, which is a group that usually buys distressed brands and with very famous logos or trademarks, and sort of revives them and exploits them well. And the two have sort of joined forces. That's a very unusual arrangement for tenant and landlord to develop a partnership. And that's somewhat interesting. The relationship existed before the pandemic, but it has proven to shield both tenant and landlord in this kind of crisis scenario. So we may see, different partnerships like this. And we saw things happen with Barney's as well as a consequence of the bankruptcy, though the Barney's the Barney's trademark was acquired by Authentic Brands Group again, and leveraged for small pop-up or boutique installations at Saks. So I think deal making may be unusual in a post-COVID world, and folks that have been on the opposite sides of the fence will start seeing synergies.
Great. So I think we're out of time. I want to thank everyone for their time. Eva, Leslie, and Rick. Really appreciate the time and the wisdom that you gave our audience today. Thank you.
Thanks for having us.
Thanks, everyone.